And welcome to episode 14 of The Rent Roll, your podcast on all things rental housing, SFR, multifamily, operations, capital markets, policy issues, the whole gamut. And today, it's going to be our final episode of 2024. We'll take a 1-week break for the holidays, for Christmas and New Year's, and we're back the day after New Year's. So join us back on January 2nd for our first episode in 2025. But today, we're talking about 2024. And what better way to end the year than to look back on all the things I got wrong for the last year, as well as some things I got right. And thankfully, there's a few more things we got right than wrong. So we'll get out the report card and we'll take a look back at things that I said and wrote going into 2024 and early parts of the year and how those themes played out. So that'll be fun. And it was kind of fun going down memory lane and looking at some of the things that did play out as expected and some that did not, and examining why those things did not happen. So we'll be transparent in looking at that and hopefully learning some lessons from it as well. So today's episode is going to be all, unfortunately for you, it's going to be all about me talking about things that I wrote and said going into the year and evaluating how that went. I don't have any other special guests today, but we'll be back with the guest format in our next episode. All right, so as always, this episode is sponsored by Madera Residential. Please check it out, maderaresidential.com. All right, so here's a chart, and we got a bunch of charts today. We're going to be looking at what I got wrong and right in 2024, and I want to start off with what I got wrong. Number one thing is I expected we would see more deal flow in 2024. Now, in fairness, I said moderately more. I thought a little bit more. I did also point out it'd be tough, but I did expect to see a little more. Instead, it's not exactly what happened. So here's what I wrote in early part of the year after NMHC's annual meeting. I wrote, quote, "Optimism is back, much different from this time last year. Not that 2024 will be a banner year. It will likely be a slog, both for operations and to find deals." I also wrote, "It's still unclear how much volume we'll see, but it seems likely more than 2023. Well, that did not happen, obviously. Instead, we're likely to end 2024 below 2023 volumes, at least on total transactions and possibly on dollar volume too. So I was right that it'd be a slog to find deals, but I was wrong in thinking we'd see a moderate pickup in deal flow. So what happened? Well, I think a few things. Number one, everyone was raising these rescue capital funds to buy discounted distressed deals, and yet we just didn't see any distress emerge in any real scale, which I don't think that part's surprising, but it just didn't really happen. That was part of the, I think, criteria for all these buyers out there. We also heard about this big wall of maturities that be hitting starting in 2024, and that really got punted down the road or we reworked, and that meant fewer deals transacting as well. And I remember going back to NMHC a year ago, you had a lot of investors out there thinking they'd be able to buy newer vintage Class A in the mid-upper fives, and maybe that was true for a hot second, but not really. And we're now in the mid-upper fours for good locations in that asset type. So I did get that part right in my predictions, by the way. I wrote, this is a quote, "Investors are increasingly resigned to seeing relatively little distress among institutional grade assets hitting the market in 2024, and that even preferred equity capital are finding surprisingly few opportunities." Another factor I think contributed to low volumes is we just didn't get the rate cuts as early or as deep as everyone expected and wanted. That's a big deal because a lot of folks, you had sellers and buyers were really waiting on that. And as they waited, sellers weren't really willing to trade at a discount prematurely, thinking that rates would come down. But buyers often needed those wider spreads for deals to pencil out. All but the biggest buyers who had a lot of cash. So instead, we saw cap rate compression where rate cuts were getting priced in before it even happened. But few buyers can do that, so that means volume is going to drop. Third factor I think contributed is that we saw optimism, and I didn't get that part right. It has been a lot of optimism, and it's been deeply rooted across the industry for a rebound in 26 and 27, maybe even starting earlier than that, with the expected drop in supply combined with these strong demand drivers. So that perceived clarity and kind of consensus made it easier for investors and for lenders to justify riding this out and not selling at a discount. So where I got it right on distress, cap rates, bifurcation, and deal flow. By the way, here's something else I wrote. I said values could be bottoming, cap rates settling in the mid 5% range. So that did play out. The average apartment cap rates would settle in the mid fives. And again, well-located Class A in the 4s noted earlier. And I was writing this part too. I wrote, I suspect well-located new construction might not get discounted as much as buyers hope, while Class C, B minus with value add needs could be more challenged as cap rates spread between A to B to C and those spreads normalize. So I still think that's an issue to work through. And by the way, I got some of these things right in these songs. I don't want to pretend like I was the only person to say some of these things. These are, I think, reflection of some pretty conventional thinking. So I'll take some of the blame where we got it wrong, and I won't take too much credit where a lot of others thought the same way and it turned out to be true. All right, let's shift gears away from capital markets to talk about fundamentals. And here's a big one that I got wrong. And I've talked about this one quite a bit. I thought we'd see renter retention rates continue to slide downward as we saw occur in 2023. And I thought that for a very simple reason. I thought renters suddenly had a ton of options given the 50-year high in supply wave, the 50-year high supply wave hitting the market, rising vacancy, and the associated impact on rents and on higher concession values and bigger concessions, I should say. And that did not play out in 2024. And I think that was a big surprise. Instead, if those of you can see the video on the chart here, retention rates did go up, even with vacancy at a 10-year high, and even with supply at a 50-year high. Retention was higher than in any year in a long time other than the 2021-2022 pandemic and inflation era. So how did that happen? Well, thankfully, I did get this part right. I just totally underestimated the impact of it. I wrote, heads on beds remains the strategy. Operators continue to give on price to maintain occupancy given the 50-year high in completions hitting in 2024, and diminished loss to lease means there's less upside on renewals. So property managers everywhere put a big focus on resident care and renewal strategy to boost occupancy and cash flow. Part of that did include moderating rent growth as well for renewals. Now, renewal tradeout came in at about 3.8% on average as of November. So obviously still solid. That's the lowest number since the first half of 2021 before the big run up. It's actually, believe it or not, it's actually below the pre-pandemic norms of 2017 to 2019. So I did get that part right too. And here's where I think I think may have happened. I mean, it's just the moderation that part I got right. I think my personal view is everyone's talking about those different factors. I think it's one thing people forget to talk about or don't talk about enough. And that is, after back-to-back years of these large renewal rent increases, renters are getting these renewal offer letters, 60, 90 plus days in advance. And, for 2 years, these are, mid to upper single digit numbers in some cases. And we'd see even double digit renewal increases. And those were, hard to stomach, even if you could afford it. And so now this third year in 2024, renters are getting these renewal offers for 2, 3, 4%, maybe 5%. They thought, low single digits. Hey, that's not so bad after these last couple of years. And I think many were just happy to see more normal increases. And if they did shop around, maybe they saw that the savings for a comparable product just wasn't worth the hassle and the frictional costs of moving. Now, by the way, I know everyone wants to rush to give credit to the stalled out single-family home market for the lack of move-outs to home purchase. And obviously, that's a contributing factor. I don't want to entirely dismiss it, but I think it's just one of several. I think we actually give it too much credit. Remember, the vast majority of move-outs in apartments are traditionally to other rentals, not to home purchase. So I don't want to give it too much credit, like I said earlier. And by the way, this is specifically to apartments. We have obviously much better data in the industry on apartments than we do single-family rentals, but I will be talking about single-family rentals on this recap as well. Another one I got wrong, though, on the multifamily side, and technically I actually got this wrong in 2023, and I corrected it going into 2024. So it's actually right about this year, but I'm going to count it as a miss since I was initially wrong before I corrected myself. And that's the impact of new supply on Class B and Class C rents. Got a chart here showing you Class C rents fell hardest in the areas adding a lot of supply, which actually saw significant Class C rent cuts in higher supplied markets, even though that new supply was typically priced significantly higher than Class C. And we also saw significant Class C rent growth in low supply markets. So it's all about supply. And I talked about this a lot previously. And again, I did correct this going into 2024, but I just want to highlight this again because what it shows is the idea of filtering playing out. So people living in more affordable and more moderate priced units moving up, I should say the higher income folks in these more moderate priced units moving up into the new supply, opening up availability at the moderate price points down and kind of downstream, really goes kind of C to B minus to B plus to A minus to new lease ups. So there's multiple pieces of the filtering story that play out, but it did put downward pressure on those Class C rents in these lower supplied markets. I'm sorry, the higher supplied markets, I should say. And you don't see that happening in the lower supplied markets. All right, let's shift to some things I got right. And thankfully, there's more of those than we got wrong. And again, I want to be very honest. I mean, some of these things, I think are more mainstream than others. I don't want to pretend like I was the only one to think some of this, but it's still fun to go back and look at it. But I'll tell you one that I did get some pushback on that I felt pretty strongly about was demand. And we did get this one right. Here's what I wrote. I said, fundamental demand for apartments is strong and should remain strong. Improved consumer confidence, a resilient job market, plus wages outpacing rents all add up to robust demand. It's not enough to keep pace with a 50-year high in new supply, but it's likely enough to keep occupancy levels fairly healthy and enough to avoid large rent cuts in most markets. And we pretty much nailed that one. We saw most of the rent cuts were going to be in the low to mid single digits. I think Austin was the worst, about 8%. And remember, it turned out that apartment absorption in 2024 was higher than any year in recent history other than 2021. So it's still not keeping pace with supply like we expected, but there is a ton of demand out there. And it's not just from would-be home buyers. It's just like in the retention side, we give that too much credit. We do the same thing on the new lease side. Remember that most new buyers are current renters. And so there's fewer move out. So I should say we do see fewer move outs with people not buying as many houses. That protects the back door, but that does not explain all the new demand coming in the front door. So this is just really kind of traditional apartment demand entering the market as a result of those things I mentioned earlier. I also wrote there'd be no doomsday for rents in 2024. I wrote, quote, the doomsday forecasters miscast the rent growth slowdown as a broad-scale cratering due to a myriad of perceived challenges from economic to affordability, et cetera. But it's really all about supply plus strong demand and improving affordability on the positive side. So that, again, played out as expected. I mentioned affordability, so let's go to the next one. I was right about affordability for market rate rentals as well. I said that wage growth will outpace rent growth. I wrote incomes are outpacing rents again and likely will through at least 2024. That means the median rent income ratios among actual lease signers could soon drop back below 23%. And if the job market remains healthy, inflation continues to cool, and rents continue to flatten or fall as expected, that means we're entering a stretch where renters have increased spending power, which is a positive trend for rental housing demand. Now, I want to clarify, this is for market rate professionally managed rentals. As I talked about previously, the rental housing market is bifurcated. There's really haves and have-nots. And you look at the professionally managed market rate rental pool, that's what we're talking about here. Obviously, there's real affordability challenges at the lower end of the market. This is the upper end of the market. And we pretty much nailed this one too. We're now at 24 straight months of wage growth topping new lease rent growth. We've erased the entirety of the hump created in the peak inflation period. And rent income ratios for new lease signers in market rate apartments fell back below 23% by the summer of this year. Now, honestly, I think this is one of the easier ones to see coming if you're tracking data instead of narratives and headlines. But I think most folks were looking at kind of the wrong thing unless you kind of live in this day to day. Again, real issues lower end of the market. I never want to downplay the real affordability challenges that exist. But in the market rate professionally managed segment that's really catering to middle and upper income renters, we saw affordability emerge as more of a tailwind than a headwind to apartment demand. And I think that'll likely continue through most of 2025. Another one we got right. Operational expenses outpaced revenues in 2024. I wrote, expense growth will outpace revenue growth in a lot of markets in 2024, but the silver lining is that expense pressures are showing signs of mitigating. I heard stories of owners thrilled to get insurance premiums renewed to the low single digits, which would be huge if it sticks. And it pretty much did for the most part. Expenses did grow faster, but a couple of silver linings did play out as expected. Number one, revenue growth flattened off. It's not getting better yet, but it's no longer getting worse. Lease revenues were up 1.6% year over year through November. OpEx is up 3.2% on a trailing 12-month basis. So that's still, expenses are growing twice as fast as revenues. That's obviously not a sustainable pattern, but expenses are cooling off significantly. They had been up nearly 10%. Now we're closer to 3%. So that's a very encouraging trend. But I think this is one I think played out as people, not just myself, expected that would happen. I mean, there was a lot of folks as they did their budgeting for 2024 who had a lot of conviction that we'd see more stable expense pressure. And that's pretty much what's happened. I've even seen some of the REITs have actually revised down their expense forecast for the year as the year played out. That's still, again, expenses are growing faster than revenues, but where that gap is narrowing. All right, I haven't talked a lot about SFR a lot yet, so let's give it some love here. And I'm happy to share one that I got right. I was of the view that SFR was not going to be immune to the same slowing rent growth we saw in apartments, even if not to the same degree. And this was a little more of a controversial take, both in the industry and outside of it. Going into the year and even early part of the year, a lot of people thought we'd see this massive resurgence in SFR rents just because of high mortgage rates and slow home sales pushing more demand into SFR. And I never really bought into that. I wrote, here's a quote, "To put it very bluntly, we need to stop assuming that a soft for sale housing market equates to a booming, quote, best of times rental market." And that was a quote from an article I was referencing, this best of times idea that SFR is entering into. And that turned out to absolutely not to be true. And so I might finish the quote here. "We need to stop assuming that a soft for sale housing market equates to a booming best of times rental market. When in history was that ever true? Never." And that has pretty much played out as expected. While SFR is outperforming multifamily, it has cooled considerably, and it has not reaccelerated even as home sales have slowed. Currently, SFR rent growth is at 3.7% year over year, according to John Burns data. That's down from a peak of about 8%. Earlier this year, I also wrote that peak rental demand and rent growth have always occurred during periods of a robust for-sale housing market. That's simply because when homes are selling, we typically see more household formation. So while there are more move-outs to purchase in a higher home sale market, there's ample demand coming in to backfill those units. So I actually think, and I'll talk more about this as we think about 2025 and beyond, I actually think it's more of a downside risk for SFR and multifamily. If you're a rental housing owner or operator, I tell people all the time, I've been saying this for years, even pre-COVID. I mean, you want to see a healthy for-sale housing market because it's more than likely going to be correlated with strong household formation and strong demand for all types of housing. So, I mean, remember what happened in 2021. It was a great year for home sales and a big year for SFR rent growth and multifamily rent growth too. So a rising tide boosts all ships. And on a lesser scale, one also point out we got right, as everybody did, easy one to call. SFR owners shifted more and more to BTR, into construction of BTR, and away from acquiring scattered site individual single family homes. So SFR market, I think, pretty much played out as expected. And by the way, I didn't get too much into this. I mean, beyond the household formation side, I think the increase of supply through BTR in some markets was a factor. The accidental landlords, people who might have sold their homes but in the rental market instead, all of these things I think contributed to the moderating but still solid rent growth that we're seeing in SFR. All right, a couple more things. Let's get into the next one here. Another one we got right, the big drop in multifamily housing starts. I wrote, "Completions at multi-decade highs will take the headlines in 2024, but just as important will be the sharp decline in starts, pointing to what will be a low supply period. New apartment construction starts plunged much more in 2023 than census data suggests, and there's a mountain of evidence that starts could drop even further in 2024. That would translate to substantially less new supply hitting the market between the second half of 2025 through 2026 and likely into 2027, end quote. So that is more and more clear today. I spent a ton of time on this on our webcasts and online and writings and whatnot, so I'm not going to say a whole lot more about it, except the starts plunged deeper in 2024 as I thought would happen. And of course, again, not just me. We completed 218,000 more units than we started through the first 10 months of 2024, and there's no sign of that changing anytime soon. Again, a lot of reasons for that, but we've covered it at length, so I'm not going to get into that more here. And last thing I want to touch on as looking back at things we said going into the year, and it was another one that was, I think, relatively easy one to forecast, and that is the Midwest and Northeast outperformance. Early in 2024, we wrote, "In the short term for 2024, we expect the Midwest and Northeast to continue outperforming due to relatively little supply plus steady demand. There's comparatively less new supply across most of the Midwest and Northeast, which creates scarcity, which keeps occupancy rates higher, which in turn keeps rent growth above the U.S. averages." And not surprisingly, that's played out in both multifamily and in the single-family rental market. In the multifamily side, 13 of the top 15 markets for effective asking rent growth are located in the Midwest, the Northeast, or the Mid-Atlantic, led by steady eddies like Detroit, Kansas City, Chicago. Richmond, Washington, D.C., Columbus, Northern New Jersey, Milwaukee, Pittsburgh, Virginia Beach, and on down the list. Cincinnati as well. We can keep going. It's a similar story for SFR. Some of the top rent growth markets in SFR include markets like Baltimore, Cincinnati, Long Island, Chicago, Milwaukee, Virginia Beach, Philadelphia, and Columbus, according to John Burns' data. So, I hear our industry sort of trained to think about, coastal markets versus Sunbelt or coastal versus interior, but that's really the wrong way to think about it. We've seen East Coast have been much stronger than the West Coast in the last few years. And really that Midwest tends to be ignored in both of those kind of comparison metrics. We think about Sunbelt and coast. So it's really, again, don't oversimplify it. Like it's actually not about coastal versus interior. It's been Midwest, Northeast, Mid-Atlantic versus the rest of the country. And obviously, variability across the rest of the country, but that's really where the strength has been. These are the steady Eddie markets, and now we're in a point in the cycle where the tortoise is winning the race, right? It's what's happened is these markets with lesser supply have seen rent growth normalize to sustainable levels, which happen to be in the 2.5% to 4% range. It's pretty normal for these parts of the country, while the rest of the country is still seeing great demand for the most part, but rent growth has been really compressed by supply. So that's and that's, by the way, not just the Sun Belt, but in parts of the West Coast as well. That's been a factor to a lesser degree, of course, than to certain high supply some markets like markets like Austin that tend to get focused on quite a bit. All right, that's gonna end the focus on the report card for 2024. We got more to cover in this podcast, but that's gonna put a wrap on the look back at what we said. I'm going to do some more predictions for the next year ahead in the next couple episodes of our podcast, as well as on social media and whatnot. But I wanted to, of course, end the year with a look back. So next, though, let's jump into rental housing trivia. All right. Today's question is, in the last 15 years, counting 2024, how many times has SFR outperformed multifamily in terms of year-over-year growth in asking rents? Is it A, 3 times, B, 6, C, 9, or D, 12 out of the last 15 years? So give that some thought, and we'll be looking back at that here in a little bit. But next up, in the news. All right, this is when we look at some headlines from the last week or so related to rental housing. First one, Wall Street Journal. Wall Street is betting billions on rental homes as ownership slips out of reach. Build-to-rent homes offer upscale amenities and desirable locations. I shared this one on LinkedIn and on Twitter/X and Blue Sky. And whenever I share anything that has to do with that touches into the relationship between owning and renting, it really brings out all kinds of characters. And certainly it did not disappoint this time either. And a lot of it really stems from just total misunderstandings of A, what this BTR market really is and what it's not. And then B, what the relationship is with the ownership market. And I think a lot of kind of misattribution to the challenges that are happening today in the for sale housing market. So the main issue I point out with this one online, I'll talk about it here briefly as well for those who missed those comments, is there was a comment from a Moody's economist that said that implied that the new supply coming into the open market is being diverted to build to rent activities. And I think that's frankly, I'm sure this person is a very skilled economist, but I think it reflects kind of an out of touch comment from somebody who's looking at the macro picture instead of really looking at what's going on in the housing market. So with all due respect, anybody following what's going on in the BTR, listening to BTR builders, this is generally additive supply. It's not supply being diverted from for sale housing. Some of the biggest builders of build to rent housing are not home builders. They're not for sale home builders. They're apartment developers and rental housing builders like Redwood Living, American Homes for Rent, Next Metro. The article the Wall Street Journal has in here, the first company referenced was Avalon Bay, which is an apartment REIT. They're entering the BTR market too. They don't build for sale housing. So they're not diverting anything from for sale housing. That was never on the table for them. I think some of the complaint stems from some of the home builders, and sometimes they'll do these pre-purchase agreements with SFR operators to sell a certain number of homes in a for sale subdivision, And if you followed that space, you know how they talked about it. It's actually helping them build more housing because it's more guaranteed revenue to help mitigate some of the risk. And in some cases, you may have builders who sell homes to investors that when these homes are struggling to sell these homes to individual buyers for whatever reason, or maybe they need a quick exit. So either way, that presence of the SFR option provides a backstop to allow them to do more of what they primarily do, which is to build for sale homes. And the other thing I'll point out too, and I'll talk about this more in a bit, is at the end of the day, which I remember is that rentals help diversify neighborhoods and make them accessible to people who couldn't otherwise afford to buy there. And I think a lot of times this anti-rental mindset is really cloaking the what's really underneath that is an anti-renter mindset. So we need to kind of move on and recognize the importance of both. It's not either or; it's both and. We need a vibrant for sale housing market. I talked about that earlier, but it's okay to have, and it's good and it's healthy to have rentals as well for those who want or need them. Next headline. This is actually from a release from the United States Senate Committee on Banking, Housing, and Urban Affairs. Senator Tim Scott, the ranking member of the Senate Committee on Banking, Housing, and Urban Affairs, met with the nominee to be the next Secretary of Housing and Urban Development, Scott Turner. So we have two Scotts here, first name Scott and last name Scott. The last name one, Senator Scott, put out a statement sharing some details on Scott Turner's priorities as HUD Secretary, should he be confirmed. He noted two things that Scott Turner noted as priorities. Number one, reduce red tape to build more housing. And number two, double down on opportunity zones to build more housing. The senator then said, I look forward to working with my colleagues to ensure his nomination is considered as quickly as possible. And he shared a photo of the two smiling next to each other. So it seems, and it certainly should be the case, that Scott Turner should be a slam dunk nominee for HUD Secretary. Certainly not one of them that's generating the controversies right now among the various people nominated for cabinet roles. And if you saw my previous commentary on Scott Turner, you know I'm a big fan of this pick. And whether you like Trump or not, I think there's good reason to be excited about Scott Turner as HUD Secretary. And remember, he'd be the first HUD Secretary in the history of the United States to come in with real-world experience as a private sector housing developer with his work at Dallas-based apartment builder JPI. Next headline comes from LAist. The headline is facing need for more housing, LA City Council votes to keep new apartments away from homeowners. So let me read briefly from this article. It says the Los Angeles City Council is facing a state-imposed deadline to rezone the city for more than 250,000 new homes. 10 of the council's 15 members rejected a proposal that would have allowed mid-sized apartment buildings in some neighborhoods zoned for single-family homes. Instead, they decided to incentivize new, larger apartment buildings in already dense urban areas. Single-family neighborhoods currently make up 72% of LA's residential land. Without opening up at least some of those areas to new development, we are, quote, not going to see affordable housing built in the city of LA sufficient to meet the need. And that came from the Director of Public Policy with the Inner City Law Center. So, bottom line here is LA leaders have found that, once again, that it's much easier just to pass laws telling apartment owners what to do than to actually be part of the solution themselves. And the fourth and final headline for the week comes from the Wall Street Journal. This one says, the housing affordability crisis is going global. Home prices and rents are rising faster than incomes in big cities in Europe and beyond. The price in Ireland is mental. All right. So let me read a little bit from this article. It says, the housing affordability crisis that has frustrated young Americans for a decade has now taken hold in many big cities in Europe and beyond. The common threads, robust job growth, rising demand, and not enough development, causing rents and sales prices to rise faster than wages. Globally, homes are now less affordable than they were in the run-up to the 2008 housing crisis, according to research published by the International Monetary Fund. The research compared median household income with the income required for an average price home across 40 countries. So this is a good reminder that housing affordability is not just an American issue. We live in our own vacuum. We don't always think about what's going on in the rest of the world. So there's a tendency to blame all kinds of boogeymen here in the U.S. for higher rents, higher home prices. It's important, though, to remember that most of these boogeymen figures that are blamed here in the U.S. really aren't even present at all outside the U.S. Yet the same problems still exist. And so maybe the boogeymen really aren't the problem, and maybe it really is all about supply and demand. Next up, the complaints department. All right. So speaking of boogeyman, I got when I shared one of the articles about the build to rent growth, I got a comment that reflected, I do this segment called the Complaints Tower because I see a lot of these kind of complaints. And I think it's so important to address them with facts because a lot of times we just hear people just complain and say things that maybe sound like they could be true, but just aren't grounded in reality and data. And so here's a comment that said, the fact is REITs and investors have indeed increased prices, affecting affordability and inventory in the housing market dramatically. The excessive amount of land in DFW used for apartments that are actually not affordable either, nor do they offer any kind of attractive lifestyle. Tiny apartments, incredibly expensive, horrible homes for rent, $2,200 for unattractive property, and very little inventory is a huge problem. More affordable housing should be built instead. Rationalize as much as you like. It's another example of greed that is destroying the fabric of our communities. All right, so very dramatic comment there. Now, a couple things I'd point out here. Remember, at housing units of different types, or I should say, let me rephrase this. Housing units are homes for people. There are different types of homes for different people. And it may not be how you prefer to live, but that's okay. Not everyone has to live the same way that you live or I live. But we need to be very careful about this kind of anti-renter rhetoric, again, disguised as anti-building or anti-investor, et cetera. Not everybody wants to or can afford to buy a home, but they still need somewhere to live. And it shouldn't be limited to the worst parts of town or to the most dense parts of town like Los Angeles is trying to do. That's not right, nor is it how we create diverse, vibrant, strong communities. Secondly, home prices grew almost twice as fast as rents since 2020. Relative to buying a home, renting is cheaper than ever. So we need to be careful with loaded terminology attacking housing providers, especially when it comes from the same people celebrating home price growth and home equity appreciation. Is a home seller or realtor greedy for selling to the highest bidder? At the end of the day, the better answer is, hey, let's just build more housing of all types, for sale, for rent, luxury, affordable, everything. And let's give people more options to live where they want to live. So hopefully we can do that. Let's just build, build, build. All right, next up, good question. All right, this is where I take a good question and try my best to give a good answer. So this question is, I got this on LinkedIn. I thought it was a great question. I have many youngish educated friends who are very much affected by the lack of affordability in California, but they believe that rent control is, quote, good and luxury housing is, quote, bad. Since local voters are largely responsible for the existence of these policies, how do we change those voters' minds? All right, great question. A couple things I would say is, number one, I think it's important to remind people, the YIMBY crowd, the SMI backyard, they've done a really good job of reminding people, I think, a common sense fact that's also well documented with data. When people say they don't want luxury housing, just affordable housing, we need to ask ourselves, hey, well, where are these wealthier renters living if there's not sufficient luxury, higher rent, more expensive housing supply? The answer is pretty obvious. They're living and competing for more moderately priced rental units that and they're competing with people who could not afford those luxury rents. So when we build newer priced housing, you're pulling higher income renters out of those more moderately priced rentals, and on down the line it goes. So I mean, that's just common sense. So I think we need to acknowledge that. We need housing of all types, but there's plenty of research out there. I posted a recent article on LinkedIn showing, and Twitter and X and Blue Sky showing kind of a starter pack for different resources to get educated on issues like inclusionary zoning, on filtering, and on rent control. And so give that a look on any one of those platforms if you missed it. But that's one thing to point out. It's just common sense. Second thing I'd point out is, I would imagine that your friends in California, they're probably people who believe in data and science. And so I think it's important to ask people, hey, in a very nice, respectful way, do you believe in science? Do you believe in data? Do you believe in academic research? And if they say no, then it's very hard to have a worthwhile discussion with somebody who just won't believe what research and facts and science and history and everything else. But if they say, yeah, of course I believe in science, of course I believe in data, and say, hey, well, do me a favor. Why don't you read some of the non-industry, non-activist academic research on these topics and decide for yourself? And there's plenty of it to find. Again, I post a starter pack on my social media channels. You can look for that. Again, it's not industry material. These are academic, non-activist, non-industry material research out there. And what you'll see is, at the end of the day, is rent control just exacerbates affordability in the long run. and by limiting availability of supply and putting more upward pressure on rents for non-rent controlled units. And again, kind of this misallocation of housing to people, putting higher income renters, incentivizing them to stay put in more moderately priced rentals as well. And on down the line it goes, the preservation of housing stock, the quality. And at the end of the day, it makes it harder for lower income households to find quality, affordable housing in those locations. So more likely, if they weren't already in place when rent control is put in place, they're likely having to go further out to then find an affordable place to live. And so it ends up backfiring the very people we're trying to protect. Now, as you get into inclusionary zoning and filtering, there's some nuances to that. I'm a big fan of, hey, it's a both and thing. So we still need to have, subsidized low income housing. You have a conversation on that. You don't want to take that away, but it's really, again, it's a both and, not an either or. And inclusionary zoning, the same thing. It's not that it's bad, but when it's unfunded, it means you could build fewer market rate units because they have to have higher rents to then offset the cost, to subsidize the cost of the affordable units. And so if it's funded in some way, then it doesn't have a negative impact on supply. But if you're just raising the rents of that market rate supply even higher, that's harder to then pencil out, because you can't just price something whatever you want it to be. It has to be demand at that price point. The laws of price elasticity of demand are still at play. So anyway, that's a little bit of a long answer, but it's a very complicated topic. It's a great question. But again, I would encourage your friends to dig into the facts. All right, last thing, rental housing trivia. Here's the answer. In the last 15 years, counting 2024, how many times did SFR outperform multifamily in terms of year-over-year rent growth, or year-over-year growth at asking rents? And the correct answer is C, 9 times in the last 15 years. Apartments did outperform in the first half of 2010's decade pretty consistently, but SFR has been more ahead more recently and will likely end 2024 with SFR rents up more than 3% compared to apartments being roughly flat. Personally, my guess here, I think we'll see them start to converge more over the next year or two. And you could actually make the case that apartments might outperform a tick better in 26 and 27, but we'll see how that plays out. The big difference between SFR and multifamily has just been supply. A lot of people don't realize this because of all the headlines that suggest otherwise, but we've actually contracted SFR supply over the last 8 years or so as individual home buyers outmuscled investors for single family homes. And this is census data, by the way. You can fact check that. It's happened. And large investors have pretty much stopped buying scattered single-family homes in favor of buying portfolios or building build-to-rent rental homes. So less supply just puts upward pressure on rents, of course. And it wasn't until last year or so when we started to see a lot of BTR hitting the market in some markets, as well as some of the increase in accidental landlords increasing supply as well. So, but that has been a factor for the last 8 or so years. That's going to wrap us up for this episode of The Rent Roll. Thank you for being with us for 14 episodes in 2024 since we've started. We've been steady every week. We're going to keep it going in 2025. The next episode, we'll be looking at what's happening, what we expect to happen in 2025. We'll have some special guests talking about what to expect on the capital market side. Will we finally see more deal flow? What's going to impact the cap rates? Will we see any impact of that big wall of maturities everybody was talking about? Will we see some distress in the market? What's going to happen to all these lease ups that are slowly going through lease up? Lots and lots of things to talk about and lots to cover. So stay with us. But in the meantime, hope everyone has a wonderful Christmas and a great New Year, and we'll see you in 2025.